Hello and welcome to Trust TV, a show designed to give insight into the mind of a professional investor. Global markets fell in 2022 as the perfect storm of rising interest rates, elevated inflation and slowing global growth weighed on investor sentiment. Meanwhile, the cost of living crisis intensified as energy prices continued to climb, whilst higher interest rates pushed up mortgage rates. With a global recession now on the cards for 2023, where can investors find refuge? My name is Georgie Frost and I'm a financial broadcaster. In this latest episode of Trust TV, we speak to Alex Crooke, portfolio manager of the Bankers Investment Trust, to discuss how he navigated a challenging year, how companies are coping with elevated inflation and higher rates amid lower consumer spending, and how the portfolio is positioned to capitalise on potential opportunities in 2023. We also talk to Alex about dividend sustainability during a period of low growth, and how global diversification and dividends could shelter investors from uncertainty and volatility. Alex, welcome to the show. Alex, 2022 was difficult for global equity markets. US equities had the worst year since 2008, and all sectors bar one, of course, energy, finished in negative territory. How did the trust perform in 2022? Just outline what some of those challenges were and how you navigated them as they played out.
There was a lot going on. There does seem to be most years a lot of events, macro events we call them, but things that are not always about looking at companies and company prospects. And the obviously key one in 22 was the invasion of Ukraine, and really what that did to energy prices initially, but then a number of goods and foods prices beyond that. Now, we were planning for higher inflation. That's what we've been talking about within the stock selection of bankers for the last couple of years, but really driven by tight labour markets, so wages gently going up, and therefore a demand for goods picking up, and therefore gently rising inflation, maybe to 2 to 4% range. But what we saw was, energy prices up 3, 4, 5-fold, and really supercharged the market. So we had to switch quite aggressively in that sort of end of that first quarter. We bought some more energy stocks. We eliminated a number of companies where energy feedstock is a big component of their cost line, I suppose. And then the rest of the year was really coping with interest rates rising very sharply, which again, probably not in our agenda right at the beginning of the year. We thought rates would rise gently with inflation, but not the rate we've seen. So yes, a number of challenging elements of this sort of, say, top-down macro elements. It's difficult when your stock selectors looking at companies trying to cope with that amount of change. So what we did really is trying to protect capital value. So when the market is falling, what was going on last year, I think, with rates rising so fast, what really puts pressure is most of the growth stocks. So they're on the highest ratings, and they're there because really they're feeding off very low interest rates and almost zero cost of capital. So what we tried to do is eliminate a number of those names. We switched out of technology in particular, but really tried to prioritise in a lot of markets more defensive names like the pharmaceuticals, healthcare, where you should see a bit more protection of value.
Well, I want to talk a little bit more about technology in a short while, but I want to focus a little bit more on this move from growth to value that really gathered pace in 2022. Have you been increasing your exposure towards more value-orientated sectors and regions?
Well, sometimes value is really, you're essentially saying sort of cheaper than average stocks, and often there's a value that they're cheap because the prospects are slightly challenged. Now, one area where we actually think the prospects are picking up and they're cheap valuations is the financials sector. So with interest rates beginning to rise, or rising quite rapidly, 4 or 5% in a number of markets now, anybody that's holding cash deposits is suddenly get a better value than they had when interest rates were zero. So the banking sector, particularly retail banks with deposits, is an obvious area where we're seeing returns pick up. There's a challenging environment. Will there be a recession? Will there be bad debts in those businesses? But we think they're very well capitalised. They've got enough capital to withstand a higher level of bad debt. So retail banking is an area we've been picking up. Investments both in America and in European markets. We've also been raising investments into insurance, which again is another area that holds a lot of assets, short-term deposits and assets. So I think that's the obvious one. The other one is energy, which we talked about earlier. Again, it was quite cheap going into the, I suppose, that Ukraine war, and for good reasons. Again, carbon is something the world is trying to reduce its level of burning carbon. But actually, as a sector, its cash flows are looking quite promising.
Well, let's talk about, as we promised, the tech sell-off. For some, of course, it offered opportunities. What is your position on that now?
So again, we've pivoted a bit. So last year had almost two phases. First one was really, get rid of very highly rated stocks. So we again sold some names into that. We saw a very strong rally right at the end of the year when the market investors are generally thinking rates are near the peak and seen, we call it a short covering, but a recovery in these very heavily oversold technology names. And we used that bit of that exposure there really to take another wave out. Actually, we're not going back in, we're taking a bit more technology out because we still think there's more pressure to come on the ratings, the valuations of these technology names. And within technology, we pivoted towards semiconductors as well. We again think as the world starts to pick up activity, particularly selling autos, a number of other areas, that we should see more investment in semiconductors. The US market in particular is onshoring, so bringing back a lot of capacity that's in Asia onto their market, and so some of those technology semi names in America should do well.
Now, regionally, different economics, monetary policies, industry dynamics, of course, are all at play, and the volatility inherent in markets is making it difficult for investors to differentiate between transitory and structural trends. So how is the portfolio positioned to benefit from long-term structural trends within each region?
What normally happens when rates rise very sharply is it does put pressure on consumer spending, it puts pressure on economies, and historically you often see a recession. Now, they're not normally very deep recessions given the environment of employment is pretty good and other aspects of the economic activity. So we're expecting a sort of mild recession. But if we look around the world, it's not going to be unified. We think America might be in recession maybe in 24. It's got a lot of savings being spent. It's still quite a robust economy this year. Europe, UK, we've sort of been in almost recessionary conditions, and I think as we go through 23 should be seeing gentle recovery. And Asia, particularly with China reopening from a sort of zero COVID, should actually see quite a lot of resumption of growth, first from the classic reopening as people get out and start spending their savings, and then beyond that as the economy gets primed for some growth. So I think that's giving us some opportunities to rotate around regions. We've been raising Asia and the Asia exposure in the last few months. Europe, we're sort of there or thereabouts, I think, and America still being quite cautious. Initially sort of capital goods and consumer goods, but probably rotating into more defensive names.
Alex, you mentioned China there. Let's focus a little bit more, if you wouldn't mind. The opening of China has boosted optimism among investors that the country is on a path to recovery. How has this changed or impacted your investment stance towards Chinese equities?
Well, it's opening very rapidly, actually, but much quicker than we thought would be the case. We thought there'd be a more gradual process. They've, for whatever reasons, decided really let's just rip the plaster off and go for it. And now with that is coming.
But is there caution with that they may put the plaster back on as quickly?
I just don't think you can. Once COVID is so infectious, once it's not constrained, you may as well just carry on. So I think more interesting is going to be how they try and get the economy going again, get some growth coming back, because things like youth unemployment is over 20%. So the COVID sort of lockdowns have had quite a material effect on a number of economically sensitive areas. We've also got the challenges, as I mentioned, about the onshoring. So a lot of what COVID did, I think, to a lot of manufacturers and a lot of countries, it has reminded them that these very long supply chains actually can be quite dangerous to their businesses when something happens and you can't get goods in a quick way. So I think a lot of this is changing the economy much more to manufacturing and consumption within China rather than export-led. And therein there are some opportunities. We historically used to own a lot of consumer goods names. As wealth is increasing, people spend more on services, eating out, travel, and we think that'll come back quite quickly. So that's an area I think we're particularly looking at within our Chinese investments.
Branching out to markets within the region, but with high household debt, so we're looking at things like Australia, of course, Malaysia, South Korea. They will be vulnerable, won't they, to rising interest rates, and the squeeze on consumer spending will likely result in slower growth in those countries. How are you taking this into account?
Well, essentially with great caution, actually. If we think of the consumer in those markets, we're really very, very little, almost no exposure to all three of those markets, actually, the consumer, because I think you're right, it's going to be reducing spending there. But on the other side is markets like Australia, where you've got amazing natural resources, and the stocks listed there, I think, have great prospects, as particularly China gets going again on its manufacturing front. So we own a number of the miners in Australia, We own some oil stocks as well. And then we move into, we don't own anything in Malaysia, but in South Korea, again, you've got some of the semiconductor manufacturers that I mentioned before, LG and Samsung within the portfolio. I think the prospects there, again, look very, very good in a global sense.
The portfolio is moderately overweight energy. Given it was the only game in town in 2022 and supply-demand dynamics remain in favour of higher oil prices, why haven't you increased your exposure to this sector?
Well, essentially, we've taken the view of the last 2 or 3 years that the world does need to decarbonise, and we need to be part of that as well. So where we invest in an oil company, we do want to see some progress towards decarbonising their business, so investing in alternate energy sources. I think the world does need a transition, though. We can't just stop all production of oil. We need to transition into alternative energies and technologies. So it's given us a cautious view. Also we felt the carbon price, the oil price was likely to fall as well, which again puts pressure on margins. Now that completely changed with the dynamics of shutting Russia out from many of the Western markets. And we've had to pivot a little bit on that. But I think still those principles apply, that if we look forward 3-5 years, the cash flows from these businesses are likely to decline over time as we have alternate sources of energy and use less carbon.
Do you believe that what we've seen, of course, with the Ukraine war and energy, that actually there's been a slight pivot, shall we say, away from greener energy, alternative energy, decarbonisation, that there may be some long-term impact on that? Or do you think that this was actually just a blip and we'll get back to where we were?
I think the difference is more in the value of those stocks. I think that the amount of capital that was sort of rushing into a sort of greener technologies, trying to take advantage of the growth there, and there was growth, but it just probably got overvalued, and therefore the reason we've seen sort of poor performance in a number of these stocks is more about just that flow of money going in and coming out again. I think the direction of travel is undoubtedly clear from a government and a social aspect, that we do need more greener technologies, lower carbon. It has to be done, but as always, it's the pace of that transition and not overpaying for technologies. So I think we'll carry on with that trend. It will have blips and it will have periods where investment flows in and flows out again.
So far, companies have been able to pass on rising costs. However, the cost of living crisis, as it intensifies and consumer spending slows, company margins will ultimately get squeezed. So what sort of conversations, what are you hearing from portfolio companies about the margin pressure resilience?
So initially, companies could see the cost pressures, I think, coming, and almost, the price of oil, price of gas, price of heating. So anything that's consuming that, they could see that coming very quickly. So I think most companies actually went to that much quicker than we'd normally expect. And therefore, the volumes sort of tailed off or tailing off as we speak, but actually they got a lot of price in early on. So margins expanded a little bit, and that confused, I think, a lot of market participants. So as we're looking at the 22 results coming through, they've been a lot more robust than actually I think market participants were thinking, which is why it's supported, I think, the stock market in the short term. Now that comes to roost eventually. You've got to sell more volume, or if volumes pick up, your stock is increasing, you've got to clear it. And we're beginning to see some of that now happening in companies that are not best in class. So again, I think if you're a very cost-efficient manufacturer, you can survive at lower margins. You're going to pick up volume because I think your peers are going to struggle to match you. So again, that's part of our stock selection process, is trying to find who can pass on prices, who's a price maker rather than a price taker. And there we'll see some resilience in margins. But we will see them coming down. We are expecting earnings to fall in 2023. The market is telling you that with its price movement last year. So I think it's beginning to be within the market prices.
What about dividends? So far, so resilient. What's your outlook for dividends in 2023?
Well, I think it remains really positive. I think a lot of companies have increased profits. We're still seeing, therefore, a flow of increasing dividends from some key sectors. And I think when we look forward, periods of higher inflation, if we look back to the 1970s, actually were pretty robust times for dividend growth. So I'm expecting some of the key sectors, the banking sector is really important, the mining sector, to continue to grow dividends. Maybe less special dividends, but consistent growth. So I think we're very positive on the outlook for dividend growth from the portfolio.
Alex, thank you so much. That's all we have time for today. Thank you very much to Alex Crooke for being our guest. We hope you found the discussion useful. We have more Trust TVs coming up, so if you do have any questions you'd like answered by a fund manager, you can get in touch via the Janus Henderson Investment Trust website page. And if you like today's episode, you can subscribe and find more content like this via the Janus Henderson Investment Trust YouTube page. And if you want to hear more from our fund managers, make sure you subscribe to Trust Radio, the Janus Henderson Investment Trust podcast, on all major podcast platforms. Goodbye for now.